This analysis is based on the following article published at the Market Oracle website on the 30th of June 2014. The Bank of England's frontman, Mark Carney, has been busy during the past few weeks putting up ever-thickening screens of smoke and mirrors so as a thick cloud of confusion surrounds the prospects for UK interest rates, as his comments literally flip-flop virtually every other week so as to appease all and mask the central bank's true intentions.
Our current guidance makes clear that we'll set monetary policy to meet the inflation target while using up that spare capacity. And this has implication for the timing, the pace, and the degree of bank rate increases. And of course, there's already great speculation about the exact timing of the first rate hike, and this decision is becoming more balanced. It could happen sooner than financial markets currently expect.
Blasting away the smoke and shattering the mirrors reveals the underlying fundamentals for rising interest rates this year. This follows on the back of what Mark Carney was stating barely a few months ago of keeping UK interest rates on hold for several more years. The banking crime syndicate has always been quick to raise rates, and so it will be again this time around, where the rate rises will materialise long before the Bank of England ushers in its first base rate hike. In this respect, the fixed mortgage interest rates have already risen over the past 6 months from an average of 2.5% to now stand at 3%. Therefore, if you are a borrower, then the smart thing to do would be to fix your mortgage for as long as possible. Savers expecting the same will be disappointed, as illustrated by the Halifax, as banks ahead of the new 15k cash ISA have actually been cutting savings rates to far below the official RPI inflation rate of 2.4%. The consensus view is that a rise in interest rates would hit the housing market hard, as mortgage interest rates could literally double even if the base rate only rose to 2.5%. However, my long-standing view has remained since at least August 2013 that the primary driver for house prices is not interest rates but sentiment. My original UK house prices forecast as of December 2013 is for average UK house prices to target a rise of 55% by the end of 2018. The updated graph for Halifax house price data for May 2014 of £185,747 compares against the forecast for May of £185,544, which illustrates that house prices over the past 6 months have shown very little deviation from the forecast, so therefore the long-term trend forecast remains on track to achieve a 55% increase by the end of 2018. The updated election forecast graph shows that, contrary to the most recent opinion polls that put the Labour Party ahead of the Tories, such as the Observer's putting Labour on 35% and Conservatives on 31%, instead the Tories have already started to enter into an outright election victory territory, some 3 months ahead of the expected trend, never mind the prospects for another coalition government, which now appear to be extremely improbable. Remember to subscribe to this YouTube channel and my free Market Oracle newsletter for regular updates.